All right, so kicking things off today, we're diving into some pretty heavy stuff.
Oh, yeah.
Yeah, Neil Ferguson, in the foreword to the book we're looking at, he paints this picture of the future. And it's kind of bleak.
Lay it on me.
He's talking persistent inflation, escalating global conflicts, basically the world ganging up on the U.S.
Okay, that's not great.
Then he throws in a weakening dollar, a bunch of countries drowning in debt, and everyone scrambling to dump their stocks and bonds for, like, actual stuff.
Commodities, real estate, things you can touch.
Exactly. And just for kicks, he tops it off with catastrophic shortages of natural resources. Like, yikes.
Sounds like we're in for a rough ride. But hey, that's why we're here, right? To make sense of it all.
Absolutely. We're not here to scare anyone, but we do need to understand what might be a pretty big shift happening in the global economy. Think of it like we're reading the map, not predicting the storm.
Exactly. And that's why you brought these sources to us, right? You're trying to figure out where we are in this whole economic landscape and what it means for your wallet.
Precisely. And the book we're really digging into today, How to Listen When Markets Speak. It has this really interesting premise.
Okay, I'm intrigued. What's the premise?
The authors, Lawrence G. McDonald and James Patrick Robinson, they argue that the market is actually speaking to us.
Okay.
And our job is to learn how to listen.
Now, this McDonald guy, he's not just some random blogger, right?
No way. He's a former Lehman Brothers trader. And he wrote Colossal Failure of Common Sense. So he's seen some stuff.
Oh, yeah. He's been in the trenches.
Big time.
Yeah.
What's cool about this book is that it's built on this financial risk model. They have 21 systemic risk indicators they track.
21. That's a pretty comprehensive checklist for, like, the health of the global financial system.
Exactly.
So where do we even begin with all of this?
Well, in this deep dive, we have a few goals. First, we need to unpack what McDonald and Robinson are really saying.
Got it.
Then, we got to look at the historical context. To understand where you're going, you got to know where you've been.
Makes sense.
And finally, and maybe this is the most important for you, we need to figure out what this all means for your investments.
All right, the million-dollar question.
Right. We're aiming for clarity, actionable insights, no jargon overload.
Sounds good to me. Let's do this.
Okay, so let's rewind a bit. Back to the end of the Cold War. It's kind of easy to forget how much that one event shook things up.
Right. It was a whole different world.
Totally. And the book connects that to the whole low inflation period we've seen since then.
Mm-hmm.
The Soviet Union collapses. Suddenly, it's the U.S. calling the shots.
A unipolar world, they call it.
Exactly. And with things relatively peaceful and stable, international trade goes through the roof. We're talking under $5 trillion in 1990, then boom, $28 trillion by 2022.
That's a huge jump.
Huge. And all that trade, it was like a giant fire hose of new supply. That had to have an impact on inflation, right?
Oh, absolutely. The end of the Cold War opened up access to all these resources, like raw materials from Russia. Then you had more finished goods being produced, cheaper labor, especially from Asia, with China really coming into the picture. All that put downward pressure on prices in the U.S. and Europe.
So inflation takes a nosedive.
Big time. From around 7% in the 70s down to 3% in the 90s, and then by the 2010s we were averaging just 1.7%.
Wow. And all that low inflation, that had to impact the financial markets, right? Like
Yeah.
If our money's not losing value as quickly, some investments become less attractive.
Right. For example, you look at U.S. Treasury yields, which are basically the return you can expect from the safest investments out there. Those plummeted from a whopping 15% in 1981 to less than 1% in the 2010s.
So suddenly those safe bets aren't looking so hot.
Exactly. And investors, they're always looking for returns, right? So they start moving towards riskier assets like stocks. And that's where the fun begins.
Fun. You mean like bubbles?
Well, that's part of the story. But also a massive bull market. Look at the S&P 500. Price-to-earnings ratios went from around 7 in the early 80s to 30 in the late 90s, and then again in 2021.
People were willing to pay way more for a company's potential future earnings.
Precisely. Low inflation created this environment where investors were hungry for growth, so they piled into growth stocks and bonds. And, the S&P 500 grew over 1,300% between 1990 and 2021.
That's insane growth. But the book, it also talks about this thing called the petrodollar agreement. What's the deal with that?
That's a fascinating piece of the puzzle. So in the 80s, the U.S. makes this deal with Saudi Arabia, right?
Okay.
Basically, Saudi Arabia agrees to price all their oil exports in U.S. dollars.
Wow.
And on top of that, they reinvest a big chunk of those dollar earnings back into U.S. Treasury bonds.
So oil, which the whole world needs, has to be bought with dollars. That creates a huge demand for U.S. currency.
Exactly. And that gives the U.S. a lot of economic leverage. James Baker III, one of Reagan's advisors, he said something like, "You never want to live in a multipolar world. Controlling oil prices was the most important thing."
That's pretty telling.
It is. And the book argues that this control over oil pricing was used in part to squeeze the Soviet Union, who were relying on oil and gas exports for hard currency. It was a pressure tactic, and some argue it contributed to their eventual collapse.
So the petrodollar agreement, it's not just about oil. It's about global power dynamics.
Right. It's this fascinating intersection of economics and geopolitics.
And it all fed into this post-Cold War low inflation boom.
Yeah.
But as the book points out, there were some, let's call them unintended consequences, especially when it comes to China.
Oh, yeah. Things get complicated with China.
Part 2 of the book really dives into globalization and specifically China joining the World Trade Organization in 2001.
A pivotal moment.
It was like a starting pistol for companies to move their manufacturing to China. Lower labor costs, less regulation. It was a no-brainer.
The book uses Dell Computer as an example. They were early adopters, and it paid off big time for them.
They slashed their production costs, right?
Exactly. But all that offshoring, it came with a price tag for the U.S.
The book lays out some pretty stark numbers on the job losses.
It does. We're talking about 3.7 million manufacturing jobs lost in the U.S. in the 17 years after China entered the WTO. And get this, China ends up holding $1 trillion of U.S. debt.
Wow. $1 trillion.
Yeah, and to give you a specific example, the U.S. computer and telecom equipment industry, they lost 1 million jobs between 1990 and 2023. But get this, the market for personal computers more than doubled in that same period.
So we're buying more computers but making fewer of them.
Right, and that just shows the deflationary power of globalization. The consumer price index for PCs and peripherals dropped by almost 100% between 1997 and 2015. You were getting so much more computing power for a fraction of the cost.
It's kind of mind-blowing how fast things changed. And on top of that, China's policies, specifically how they manage their currency, that also played a role in keeping U.S. interest rates low, right? Which, if I'm following this correctly, contributed to our growing debt.
You got it. China had this policy of pegging the yuan to the U.S. dollar. They'd buy tons of U.S. Treasury bonds to prevent the yuan from appreciating too much.
So they were manipulating their currency.
Well, that's one way to put it. But the effect was that it created this huge demand for U.S. treasuries, which kept U.S. interest rates artificially low.
Okay, so it was like a balancing act.
Yeah.
They keep their exports cheap, we get cheap goods, but our manufacturing suffers and we rack up debt.
It was a trade-off. And the book argues that this flood of cheap capital also led to some, well, excesses.
You talking bubbles again?
Well, the dot-com bubble is a prime example. All this cheap money sloshing around. People get overexcited about the internet, and suddenly you have companies with no real business models going public and their stock prices going through the roof.
Like that drcoup.com thing.
Exactly. A former surgeon general starts a health information website, and everyone's throwing money at it. It was irrational exuberance, fueled by cheap credit.
And didn't all that easy money also play a role in those corporate scandals like Enron and WorldCom?
Oh, absolutely. Companies were taking on huge amounts of debt, cooking their books, all to keep up the illusion of growth. It was a recipe for disaster.
Okay, so we've got the end of the Cold War, the rise of China, all this cheap money floating around, and then the book shifts gears to what it calls the era of bailouts.
Ah, yes. Japan and the lessons, or maybe misapplied lessons, that led to the U.S. bailouts.
So what's the main argument here?
The book's really digging into this concept of moral hazard. They're saying that when central banks and governments keep stepping in to save the day, to prevent big market crashes...
It creates a safety net.
Yeah, but that safety net, it can backfire. It creates this expectation that someone will always be there to bail you out.
So people take bigger risks because they think there's no downside.
Exactly, and that can distort the natural ups and downs of the market. The book starts by looking at Japan's asset bubble in the late 80s and early 90s. Part of that was triggered by the Plaza Accord, which weakened the Japanese yen and led to interest rate cuts.
So like a domino effect.
Yeah, and you see these crazy real estate valuations in Tokyo. It was a classic bubble. Yeah. And the interesting thing is that Ben Bernanke, who later became the Fed chair, he studied Japan's experience really closely.
Because he was worried about deflation.
Right. He was looking for ways to avoid a similar situation in the U.S., and that research heavily influenced his approach to the 2008 financial crisis.
Zero interest rates, quantitative easing, all that.
Exactly. It was his blueprint for avoiding a deflationary spiral. But the book suggests that this approach, this heavy intervention, it might have been directly influenced by what were seen as policy failures in Japan.
Interesting. And then we get to the LTCM crisis in 1998. That felt like a major turning point in how the U.S. dealt with financial crises.
Oh, absolutely. Long-term capital management, or LTCM, was this super smart hedge fund. They were making tons of money by exploiting tiny price differences in the market. But they were using massive amounts of borrowed money, like 30 times their actual capital.
That's a lot of leverage.
Huge leverage. And then you have the Asian financial crisis, and Russia defaults on its debt. Suddenly, the markets go haywire.
And LTCM's bets blow up.
Big time. And because they were so interconnected with other financial institutions, the whole system was at risk. William McDonough, who was running the New York Fed at the time, he famously said the market could stop functioning.
So the Fed steps in to save the day.
Right. They orchestrated a bailout of LTCM, deeming it too big to fail. And the book argues that this was a key moment where the Fed started actively intervening to prop up the markets.
It wasn't just letting things play out naturally anymore. Exactly. And this pattern continued. The dot-com bubble bursts. The Fed cuts interest rates. 9/11 happens. The Fed cuts rates again.
So the market starts to expect this, right? Like the Fed will always be there to cushion the fall. Precisely. That's what they call the Fed put. It's this belief that the Fed will always step in to prevent a major market crash. And the book argues that this kind of constant intervention, it goes against the whole idea of the free market self-correcting.
It's almost like we've become addicted to the Fed's medicine.
In a way, yeah. And the book also points out how the dominant sectors of the U.S. economy have shifted over time. In the early 80s, it was all about physical assets like energy, industrials, materials.
The old economy.
Right. Then, before the 2008 crisis, financials took over. And now, it's all about tech.
So each era has its darlings.
Exactly. And the question the book raises is this concentration in tech sustainable, especially in a world where inflation might be making a comeback?
Okay, so we've covered the rise of this low inflation world and how the Fed has become more and more involved in the markets. But the book argues that we're at a turning point. We're moving into a multipolar world where inflation is here to stay.
Right. The tide is turning. And the interview with Andreas Steves, the founder of BTG Pactual, that was really eye-opening.
What did he have to say?
Well, Steves has a lot of experience dealing with inflation in Brazil, and back in early 2022, he was already warning that the U.S. might be underestimating how stubborn inflation can be. He said, inflation is a very tricky thing, and it often happens silently. The thing about inflation is, it lasts a long time.
So he was seeing the warning signs.
Definitely. And he also talked about how geopolitics are changing. We're moving away from this globalized, just-in-time supply chain model.
The one that was so good at keeping prices low.
Exactly. Now it's more about regionalization, security, countries wanting to be less reliant on China.
And all that has implications for the U.S. dollar, right?
Absolutely. The book talks about how countries like Russia, China, and even Saudi Arabia, they're looking for alternatives to the dollar. They want to trade in other currencies, hold reserves in other currencies.
So the dollar's dominance is being challenged.
Yes.
Yeah.
And that could make it harder for the U.S. to finance its debt. If there's less demand for dollars, the dollar weakens.
It's not good. And the book also mentions how labor could gain more power in this inflationary environment.
Right. When prices are rising, workers demand higher wages to keep up. That can lead to stronger unions, more strikes.
And that can make inflation even worse.
Exactly. It becomes a vicious cycle. Businesses raise prices because their costs are higher, workers demand higher wages, and so on.
A wage price spiral.
Exactly. And then you have the energy situation, which the book says is going to keep upward pressure on prices.
Because of underinvestment in fossil fuels.
Right. And also the strained relationships with some major energy producers. Energy is essential for everything. So when energy prices go up, everything goes up.
And on top of that, there's the issue of resource scarcity.
Yeah, just like Ferguson mentioned in the foreword, the book is predicting catastrophic shortages of key resources, partly because of a population growth, partly because of the green energy transition. We need lithium, cobalt, all these things, and there might not be enough to go around.
So suddenly, owning those physical assets, the actual stuff, it becomes more important.
Exactly. It's a different way of thinking about investing. And that leads to the book's argument about moving away from the traditional 60-40 stock and bond portfolio.
That's the classic advice, right?
It has been for a long time. But in this new world of persistent inflation, the book suggests that investors need to consider other options, commodities, for example, and maybe even holding more cash.
So diversification is more important than ever.
Absolutely. You got to adapt to the changing landscape.
And finally, the book touches on this theory of fourth turnings. Can you give us a quick rundown of that?
Sure. It's a theory that says history moves in roughly 80-year cycles, and each cycle has four distinct phases: a high, an awakening, an unraveling, and a crisis. The book suggests we're either entering or already in a crisis phase.
Which kind of fits with the whole idea that the world is changing in a big way.
Exactly. It's a time of upheaval where old systems break down and new ones emerge.
Okay, so we've covered a lot of ground here. What are the big takeaways from our deep dive into how to listen when markets speak?
Well, I think the main takeaway is that the era of low inflation, the one we've gotten used to, it's probably over.
Because of geopolitics, the rise of China, all that.
Right. And we also talked about how the Fed's interventions, while maybe well-intentioned, might have created some unintended consequences.
Like the moral hazard problem.
Exactly. And now we're moving into this multipolar world with persistent inflation. It's a very different environment than what we've seen in recent decades.
And for our listeners, what does all this mean for them, for their investments?
Well, the book suggests that there's going to be a massive shift in how capital is allocated. We're talking trillions of dollars.
Yeah.
As investors try to adapt to this new reality.
So staying informed and being willing to adjust your strategy is key.
Absolutely. What worked in the past might not work in the future.
That's a good point to end on. As we wrap up this deep dive, here's a question for you to think about. What assumptions are you making about the markets? Are you stuck in the old way of thinking? It's worth taking some time to really consider what a multipolar world with persistent inflation means for your financial future.
Food for thought.
Thanks for joining us on the deep dive.